What's up, ladies and gentlemen? Welcome to a weekend edition of the Beat of Business. Today, we're going to be talking about inflation, treasury yields, and how some of my favorite stocks are getting hammered and why I'm going to be buying more of them to reduce my average cost over the course of this week and maybe next week. I'll go over what I currently own and what I plan to buy and what I've sold over the past couple of weeks. I think that we can all agree that the last couple of weeks have been a total roller coaster. And the main reason for this are inflation fears. And that's what they are. They are fears. And now you may see this thrown around as reflation, which may sound confusing, but reflation just means that we're going to enter a period of increased inflation after a period of low inflation, which we've seen since the pandemic hit. Now, back in April and May of 2020, we saw inflation go as low as 0.3 and 0.1% in April and May, which is far below the 2% target the Federal Reserve considers healthy. But as you can see, inflation has rebounded to about 1.4%, but it's still well below the 2% target the Federal Reserve has set. Now, this is important because we're going to see all of the media outlets, hype up year-over-year inflation growth, but we have to remember that inflation was abnormally low in April and May of last year when the pandemic first started. So when we start hearing people saying inflation has doubled or that inflation is up 150%, just remember that we had a period of abnormally low inflation last year. Now, the classic stock play during a time like this is to sell the growth stocks like the high-flying tech stocks that I personally love and to reposition your portfolio and buy some of the cyclical stocks that are better positioned for a rapidly growing economy. The markets are betting that the economy is going to be back to normal sooner rather than later with the success of the current Pfizer and Moderna vaccines and the rollout of J&J's one-dose vaccine. And the companies that will benefit the most from a wide open economy are the companies that are being rewarded over the past couple of weeks. And let's talk about why this happens. Now, before we move forward, I would like to ask everyone to hit that like and subscribe button for the YouTube algorithm so others are recommended my content. If you've missed any of my past videos, you can go to my YouTube channel or you can go to my website, thebeatofbusiness.com. Now, as we've talked about on this channel before, inflation affects different parts of the economy in different ways. Now, let me explain. Now, let's take a look at a company like Apple or Microsoft or even Tesla. Now that the economy is expected to open back up, Apple's not going to say, you know what, let me charge more for my MacBooks or let me charge more for iPhones and let's charge more for AirPods. Now, similarly, Tesla's not going to say, oh gosh, the economy is opening back up. Let me increase the price of the Model 3 or the Model S. And that can be said about Microsoft, it can be said about Google, and it can be said about pretty much any of the high growth tech stocks. They just don't have the operating leverage to increase prices in this type of environment. I mean, could you imagine if Apple started charging more for their phones, or if Amazon or Microsoft started charging more for their enterprise products based on the fact that the economy is opening back up? No, it just doesn't work like that. But now let's take a look at this from a different point of view, and let's talk about the companies that do have operating leverage. Now, operating leverage is the ability to make more money off of a fixed cost. Let's talk about all of the hotel companies and all the theme parks and all the cruise companies or the airlines. Now, these companies have the operating leverage to increase their prices based on demand. Now, if the whole world is traveling and everyone is planning, their summer vacations, do you think hotel prices are going to stay stagnant? Do you think that, airline prices are going to stay stagnant? You can bet your last dollar that these companies are going to be raking in the dough with the reopening of the economy. Companies like Alaska Airlines is not only going to be filling their planes with a much higher number of passengers, but they're also going to be charging more for those seats. The same can be said for a company like Hilton. Not only are the hotels going to be 100% occupied, Hilton is also going to charge more for those rooms. And the same can be said for the cruise lines, the theme parks, etc. Now, the earnings estimates for these reopening trade companies already have or will go through the roof, and earning estimates are what drive stock prices higher, and that's what we are seeing right now. And over the past month, we've also seen bond yields continue their rapid ascent with the 10-year Treasury note topping out at around 1.6%. Now, it's not so much the fact that yields are going up. I'd attribute it more to the speed at which they are going up. The speed at which they're going up has forced investors to re-examine how they value stocks, how they value bonds, and pretty much every other investment on the planet. Now, for years, yields have been ultra low for treasuries, meaning investors earn very little interest for owning them. And that in turn made stocks and every other investment more attractive, which also drove up their price. But when treasury yields rise, as we're seeing right now, so does the downward pressure on prices for pretty much every other investment. Now, rising treasury yields are also impacted by, you guessed it, inflation. And inflation means future payments from bonds won't buy as much because the price of a cup of coffee or a bouquet of flowers or whatever you're buying will be higher than it is today. So when inflation expectations rise, bonds become less desirable and their prices fall, which in turn pushes up their yield. It's important to remember that much of this is driven by expectation. If the expectation is that inflation will go over 2%, then why in the world would anybody invest in a 10-year treasury note that only pays 1.6%? If your investment isn't even keeping up with inflation, then why would you buy it? All right, I'll be honest, my portfolio, like many of yours, has gotten hammered over the past couple of weeks. Now, a bulk of my exposure is to high growth tech stocks, and I'm totally okay with that. Now, many investors think that this is the beginning of the end for high growth tech stocks, but I personally don't feel that way. I think this is a welcomed correction, and I'm happy to look at it as a buying opportunity. I mean, I get it. Seeing your money disappear is no fun, and that's why investing in the stock market isn't for everybody. It's all fun and games until somebody gets hurt, and right now, people are getting hurt. I personally like growth stocks, and when you like growth stocks, you have to be prepared to take a hit, and you have to be prepared to make some money and lose some money. It's just the name of the game. When we've had corrections like this in the past, I've tried to sell my positions, sometimes at a loss, and buy them back at a lower price. But to be honest, I've never had luck with timing the markets like that. If that works for you, then awesome. I just try to remember why I bought the stock in the first place and remind myself that the reason I invest is to build long-term wealth and not short-term wealth. And when I look at the big picture, I have no doubt that in 1, 2, 3, 5 years' time, we will look at this sell-off as a buying opportunity, and that's what I'm treating it as. Now, currently the biggest positions in my portfolio are the ARK Innovation Fund. I've got Amazon, Apple, Facebook, Microsoft, AMD, General Motors, Tesla, the Block ETF, Uber, Ford, and Lee Motors. I sold out of my position in NEO a couple of weeks ago, and in hindsight, it was a brilliant move, but I do plan on getting back into that stock in the future. Now, my portfolio looks a lot different than it did just a few weeks ago because on February 23rd, I did some serious trading and some rebalancing in my portfolio. I sold out of my positions in, are you ready for this? DocuSign, NVIDIA, Qualcomm, Capri Holdings, Alaska Airlines. I sold some of my Uber stake. I sold Twitter, Carnival Cruise Lines. I sold Vroom, Invitation Homes. I sold JP Morgan, Wynn, Etsy, and Virgin Galactic. In most cases, I took my profits and I ran to the bank, but I also found that having 40 to 50 different stocks in my portfolio was just getting a little difficult to manage. So I lowered my total number of positions to about 22 holdings, and I plan to keep it in that ballpark going into the reopening of the economy. I know I haven't really discussed what I own in past videos, but if you like more of this type of content, I can do this more often. In general, I wanted to discuss the impact of inflation on the broader market, and I also wanted to provide my viewers with some insight into what I personally own. I wanted to do it on a weekend when there's, a sense of calm and everything isn't so crazy. But if you have any questions, comments, or suggestions, please be sure to leave a comment below and I'll definitely get back to you. With that, I hope you all learned something new today, and I'll see you next time.
I've been around the world, I've seen a million girls, but no matter what I do, ain't nobody like